Financial, where we forge stronger portfolios by cutting through all the market weakness. We don't mess with hype, we focus on numbers, structure, and pure strength. And today, we are putting a major player, the insurance brokerage firm Brown & Brown, ticker BRO, under the microscope. They just dropped their Q4 earnings, and frankly, the headlines are a mess. So our job is to stress test these financials and see if this company is built on solid bedrock or if it's just sitting on a sinkhole. Let's get to work.
All right, let's jump right in with the numbers that are catching everyone's eye. On the one hand, you see this absolutely massive jump in Q4 total revenue, up almost 36%. A number like that just screams growth, right? It looks like a rocket ship. So is this a no-brainer? Is this a clear buy signal? Not so fast. You have to look at the other side of this slide. Organic revenue, down almost 3%. Now these two numbers, they tell completely different stories. One says the company is absolutely exploding. The other says its core business is actually shrinking. That is a massive contradiction. And whenever we see a conflict this stark, you know we have to dig deeper.
So that's the central question for this whole thing. Which number is telling the truth? Is that 36% growth a sign of a powerful, expanding enterprise? Or is it just a facade, masking a weakening core? So how do we find out? We're going to put Brown & Brown through the iron financial stress test. We're going to examine the materials, we're going to check the load-bearing columns, and we're going to see if there are any cracks in this company's armor. We are going to find out if this structure can actually handle the weight it's carrying.
Okay, so here's our blueprint. This is how we're going to tear this down to the studs. First, we're going to dissect that tale of two headlines. Second, we'll ask the crucial question, was this growth bought or built? Then we're going to move to the bottom line and decode the profit puzzle. And right after that, we'll calculate the price of expansion. Exactly. We're going to finish by following the real money, the cash flow, before we deliver the iron verdict. Let's get started.
Let's start with Section 1, a tale of two headlines. This is where we lay out all the key performance indicators right from their earnings release. And as you're about to see, the story they tell is, well, it's anything but simple. It's a real mix of some impressive gains and some pretty worrying declines. It's our job to sort through all of that noise.
So just look at this. Total revenue, up nearly 36%. Net income, up over 25%. And the number that management really wants you to focus on, adjusted earnings per share, is up a pretty solid 8.1%. I mean, on the surface, that looks like a strong quarter. Any company would be happy to post numbers like that. But then you look at the other metrics. The official, generally accepted accounting principles, or GAAP, earnings per share. Well, that actually fell by over 19%. And as we've already pointed out, organic revenue went backwards. This isn't just noise, it's a fundamental disconnect. One set of these numbers is based on standard, by-the-book accounting, and the other is a custom-built narrative.
Now, listen to the CEO's own words here. He highlights, and I'm quoting, the acquisition of Accession, strong revenue growth, and adjusted diluted net income per share growth. He's telling you exactly how to read his report. He's pointing you away from the bad numbers, precisely. He's pointing away from the GAAP numbers and that organic decline and pointing you directly toward the acquisition and the adjusted figures. This is not an accident. This is management framing the narrative. They're telling you the story is about buying growth and using non-standard metrics to measure their success. Our job is to look behind that story.
And that moves us to Section 2. This gets us to the absolute core of the issue. Growth. Was it bought or was it built? To understand the true health and durability of any business, you have to know where its growth is coming from. Is it coming from the hard work of selling more products and services to more customers day in and day out? Or is it coming from writing a huge check to buy someone else's business? Let's find out. This table right here, this is the key. This is the company's own math, showing us exactly how they get from their massive headline revenue number all the way down to that negative organic number. Look at the top line. Core commissions and fees of nearly $1.5 billion. That's the starting point. Now, as you look further down, you'll see a few lines for things like profit sharing and currency translation, but then you see the big one, the line item for acquisitions. $407 million. In a single quarter. This is the smoking gun. This is the source of that massive 36% revenue jump. It wasn't forged in their existing business. It was bolted on through acquisitions. So they're literally just subtracting this huge number from their core revenue just to calculate their organic growth.
Exactly.
This single number accounts for a huge portion of that year-over-year revenue increase. Now, look, it's not a bad thing to acquire companies, but when the acquired revenue is masking a decline in the core business, you have to pay very, very close attention.
Okay, hold on. Let's back up and make sure everyone's crystal clear on this.
What exactly is organic revenue, and why does it matter so much? It's the single best metric for measuring the core health of a business. Think of it like this. It's the revenue you generate from the foundation you've already built. It strips out all the noise, the buying of other companies, the selling of divisions, the crazy fluctuations of foreign currency. It tells you apples to apples if your underlying business is growing or shrinking. A company can post huge headline revenue growth by constantly buying other companies. But if its organic revenue is flat, or worse, declining, it means the core engine is sputtering. It's an absolutely critical stress test for performance.
All right, let's move on to Section 3, decoding the profit puzzle. We've established that the top-line revenue growth is almost entirely acquired. So now we have to look at the bottom line, profit. The company's bragging about its adjusted profit, but is that profit as solid as they claim? Or is it just a coat of financial paint hiding a weaker structure underneath? This is where financial engineering can get pretty tricky, so we really need to be precise here.
And here we are again. You see it on the one hand, the company's own custom-made number, Adjusted Diluted EPS, is up over 8%. That seems pretty solid. But the official, audited, SEC-approved number, GAAP Diluted EPS, is down almost 20%. That's a huge drop in profitability and a massive difference. So where is that gap coming from? What exactly are they adjusting to turn a 19% loss into an 8% gain? The answer tells you everything you need to know about the quality of these earnings. So how did they pull off this magic trick? Well, this table right here, it illustrates it perfectly. This is the reconciliation table. This is where the magic happens. The company is legally required to show you their math, to show you how they get from the official GAAP number to their preferred adjusted number. Think of this table as a list of all the real costs and expenses they are asking you, the investor, to just please ignore. They are literally adding these costs back into their earnings to make that final number look a whole lot better. So, let's break down the two biggest ones.
The first major adjustment is amortization. They have added back 27 cents per share for this. Now, what is it? When a company buys another company, they often pay a lot more than the book value of the assets. That extra amount gets recorded as intangible assets, things like customer relationships or brand names. Amortization is the accounting practice of gradually writing down the value of these intangible assets over time. Management will tell you it's a non-cash charge, and that's technically true. No cash leaves the bank for amortization itself, but it represents a very real cost. It's the cost of the premium they paid for an acquisition just slowly bleeding away. Ignoring it is like ignoring the slow depreciation of a brand new machine you just bought for your factory.
And here's the next one, acquisition and integration costs. They've added back another 6 cents per share for this. So wait a minute, you're telling me these are the actual cash costs of doing the deals? Like legal fees, banking fees, IT integration? Yes, real money going out the door to facilitate the very acquisition strategy that's driving their headline growth. Is that really a legitimate thing to exclude? To me, if your entire corporate strategy is growth by acquisition, then the costs of making those acquisitions are a fundamental part of your operating expenses. Stripping them out feels like you're trying to have your cake and eat it too. It makes the underlying profitability of their strategy look much, much better than it actually is.
Okay, so let's recap where we are. The growth is bought, not built, and the adjusted profits rely on ignoring many of the real costs of that strategy. It's all tied to one thing, acquisitions. So the next logical step in our stress test is to go examine the balance sheet. Exactly. Let's move to Section 4. We need to see how they paid for all this expansion and, more importantly, if the company's foundation can handle all the new weight they've just piled on top of it.
I mean, just look at the sheer scale of this expansion. In a single year, the company's total assets ballooned from $17.6 billion to nearly $30 billion. That is a massive transformation, and it was driven almost entirely by that acquisition of Accession that the CEO mentioned. The company is just fundamentally larger than it was 12 months ago. But bigger isn't always stronger. We have to look at the quality of these new assets.
Okay, so let's break down that asset growth, because this chart is really revealing. Of the roughly $12 billion in new assets, over $10 billion of it comes from just two line items: goodwill, which increased by $7.1 billion, and intangible assets, which increased by $3.1 billion. So what are these? These aren't hard assets like buildings or cash, right? No, not at all. Goodwill is essentially the premium you pay for a company above its tangible net worth. It's really just an accounting plug. And we already discussed intangible assets. This means the vast majority of what they bought is ephemeral. It's brand names, customer lists, and promises of future value. Is that risky? Absolutely.
Goodwill and intangible assets can be written down or impaired if the acquired company doesn't perform as expected, and that can lead to massive losses down the road. It adds a very real layer of fragility to the balance sheet.
Now, here's the price tag. How did they pay for all that goodwill and those intangible assets? With debt. A lot of it. Long-term debt has nearly doubled in 1 year, from $3.6 billion to almost $7 billion. That's a massive weight for the company to carry. It is what we call load-bearing debt. It is not just a number on a page. It's a massive weight that the company's earnings and cash flow now have to support quarter after quarter, year after year. The question is no longer just are they growing, but can they generate enough real cash to carry this load?
And that leads us directly to Section 5, the ultimate stress test, following the real money. Forget adjusted earnings, forget goodwill. The cash flow statement doesn't lie. It shows you exactly how much actual cash is coming in the door and where it's all going. And for a company that just took on billions in new debt, this has to be the most critical document to analyze. The question is simple. Does the business generate enough real cash to pay its bills, fund its operations, and service that mountain of debt? Let's find out.
Okay, let's break this down. The first line is the good news, and it's important news. Net cash from operating activities is strong, and it's growing from $1.17 billion to $1.45 billion. This shows that the underlying business, including all the newly acquired parts, does generate a healthy amount of cash. That's a solid pillar. But look at the next line. Payments for businesses acquired a cash outlay of nearly $8 billion. So how in the world did they fund that massive gap? The next two lines tell the story. They took on over $4 billion in new debt, and they issued over $4 billion in new common stock, which dilutes existing shareholders. The cash flow story is clear. The core operations are a cash-generating machine, but that cash is completely dwarfed by the cost of their acquisition strategy, forcing them to rely on massive injections of debt and equity capital just to fund their growth.
Which brings us to our final section, the iron verdict. We've stress-tested the headlines, we've analyzed the growth engine, we decoded the profits, we counted the cost on the balance sheet, and we followed the cash. Now it's time to weigh all the evidence. Is Brown & Brown a company forged from investment-grade steel, or is it a rust bucket in disguise, held together by financial paint and leverage?
So let's lay it all out. The bull case is pretty clear. This is a company on an aggressive M&A growth path. They are rapidly expanding their market share, and their adjusted earnings and operating cash flow are growing. You just can't deny that they are building a much larger enterprise. But the bear case, the cracks in the armor, is just as compelling. That growth is masking negative organic performance in the latest quarter. It's been funded by a massive new debt load. The company's narrative relies heavily on these non-GAAP metrics that exclude very real costs. And the balance sheet is now bloated with goodwill, an intangible asset that carries inherent risk. The growth is undeniable, but so is the leverage and the complexity. The structure is bigger, but is it more brittle?
So here it is, the iron verdict. Brown & Brown is a powerful growth machine, but it's a machine built almost entirely on acquisition and leverage. This is not a simple story of organic expansion. It's a complex, high-stakes construction project. The high-leverage foundation and the heavy reliance on adjusted metrics mean that this is not a stock for the faint of heart. So it's for investors who understand the architecture, who have a high tolerance for leverage, and who accept the risks that come with a strategy this aggressive.
Precisely. The future of this stock doesn't rest on past performance, but on one critical factor: their ability to integrate these massive acquisitions and forge genuine long-term organic growth from them. Until they prove they can do that, this structure remains under observation. The foundation is carrying a heavy load, and any sign of stress could cause the entire building to crumble.